Good evening, sir.
Good evening, Pareshji. I was looking at that question which you had raised. Very interesting.
Yeah.
Why do different ETFs have different
Different
NAV?
NAVs,
And
yeah.
I found that very interesting article on the web. I have sent all of you the link.
I read that article.
So if you read the article, one of the big things, there are two things basically which are responsible for this. First of all, the charges are different.
Right.
So since the charge is deducted from the total asset value, the NAV will be different. That is number one. And the second one, which is actually also a very big part of it, is what they call tracking error.
Tracking.
Tracking error.
Expense ratio. Tracking and expense ratio.
So expense ratio is obviously one reason. Different ETFs have different expense ratios. Therefore, since these different ETFs have different expense ratios, so the NAVs will be affected. That is one reason. The other reason is the tracking. Now, the concept of tracking is whenever a mutual fund manager links his fund to a particular index, like for example, the gold is an index. So whatever, since he is only buying gold, he's supposed to always be buying it at the same price as is quoted in the market. But what that article is saying is that sometimes there are small variations. Some deals are made, there are delays in actual settlement, and because of that, it goes off track a bit. That is what the tracking error is about. So it is unable to give you exactly the same as the gold price. This also happens in the case of index funds. An index fund is supposed to track the index. Let's say you are tracking the Sensex, then it is supposed to stay very close to the Sensex always. But even there are occasions when the fund manager is unable to stay exactly on the same point as the Sensex. So there is a slight variation, and that slight variation is referred to as tracking error. So I think this explains the issue, Pareshji. What do you feel?
Yes, sir. Yes.
It's explained. So in that case, I made a little effort on that point, other point which all of you had raised regarding Okay. I think there was some problem in between. Just a minute. Okay, let me just start this again. Fine. Okay. So this is a normal profit and loss account. So we see out here we have the gross profit of 4 lakhs and all the expenses that are related to the running of the business. We have those here. And if you total all these expenses, you come to 1,61,000 and you get an operating income of 2,39,000. Then there is this non-operating income for example, I've given interest on investments. It could also be sale of an asset, anything which is not directly linked with the actual running of the business. And still, if there is income, then it is non-operating income. So if you add all this together, you are getting a net income or net profit of 290,000. Now, the question that we were discussing yesterday when we were closing was regarding depreciation and why depreciation is charged on a yearly basis. So what I did was I have made this little, this little slide here, which will explain things to a certain extent. Let me just try to take you through this slide. So suppose a company wants to purchase a machine that costs rupees 10 lakhs. The life of the machine is 10 years, after which it has to be replaced. So how will you account for this? See, this depreciation thing, to understand it, you have to understand the way it is actually accounted for on the books of the company. So whenever any transaction is made, any amount of money is spent on anything, or any amount of money is received, the first thing which the accountant will do, he will pass a journal entry. That means हमारे जो पुराने जो बही खाते वाले जो ये होते थे सिस्टम, उसमें ये बेसिकली जर्नल इज द बही. तो इसमें एक एंट्री वो करेगा. So let's say that this machine has been bought. So he will say bank account credit 10 lakh, fixed asset will be debited by 10 lakhs. Now, this may look a little odd that you are crediting the bank account. Think of it like this, that whenever something, the rule here is debit what comes in, credit what goes out. So in the case of this type of account, where we have real accounts, like you can think of the machine as a real account, what will happen is the accounting rule is debit what comes in, credit what goes out. So basically what happens here is you will credit the bank account. In the actual bank account maintained by the bank, this entry will be shown as a debit. So it is like a mirror entry. This is just for your information. So whenever the company accountant wants to reconcile the bank account, all the debits in the bank account, are basically considered to be credits in the company's account. All the credits in the company's account are considered to be debits in the bank account. So the first journal entry this is made. After that, an account is opened. An account is opened specifically for the machine. Details of the machine will be put there, the date of purchase, the type of machine, the amount of depreciation that is going to be charged. So even when we worked in the bank, there used to be these ledgers in which every single asset that the bank bought, those assets had to be recorded in the ledger. And the ledger was one page. On top, you would write the details of the asset. And then every year, the depreciation amount would be credited. Now, since this is a debit balance, the credit will reduce the balance. These are always reversed. No? So since remember we said that fixed asset is a machine, and this fixed asset is a debit balance in the here. So it is a debit balance here also. Every year depreciation is charged. Let us say you have 10 years. Life of the machine is 10 years. Every year you are charging one. Every year the value of the asset is being reduced by this amount. This also means that in the balance sheet, where I am writing fixed assets, there also this reduced value will be written in the balance sheet. So when you look at the balance sheet and you see fixed assets written there, suppose that company had only this machine as a fixed asset. This was the only fixed asset that the machine that the company had. Then in that case, what will happen is they will write 10 lakhs in the first year, 9 lakhs in the second year, 8 lakhs in the third year, etc. And the word they used there is net block asset, net of depreciation. So every year you are reducing the value of the asset, and this, since this is an expense, this depreciation is considered as an expense, this depreciation is coming in your profit and loss. So what happens is that the profit and loss account is gradually, it will gradually reflect. Instead of doing it in 1 year, if I do it in 1 year, it is going to have a different impact. Look what happens if you do it in 1 year. So when depreciation is charged every year, let us say the gross profit is 5 lakhs and all expenses other than depreciation, all that rent and insurance and salaries and wages and power bills and everything, let us say that comes to 2 lakhs. You charge depreciation, total expenses is 3 lakhs, your net profit will be 2 lakhs. Now suppose you don't charge depreciation at all. You do depreciation only when the asset has completed its life. When you have completed its life, and if you have not charged depreciation in between, the day you replace the asset, you will have to pass a 10 lakh entry because that 10 lakh is there in your books. How will you finish it off? So you will pass a 10 lakh depreciation entry in 1 year. In that case, what will happen is, imagine the same situation here now. Gross profit is 5 lakhs, expenses other than depreciation is 2 lakhs. Now you say 10 lakhs depreciation. Total expenses will become 12 lakhs. Your net profit will now become a net loss of 7 lakhs. So this means that the business is going to be, suddenly everybody will say that this has become a loss-making business. Apart from the fact that you are charging this 10 lakhs on the profit made during 1 year, although this 10 lakhs relates to the work done by the machine in 10 years. This is why you have to charge depreciation every year. Does this make sense to all of you?
Yes.
So this is the logic behind having depreciation on a yearly basis. So I thought, let me just start with this, clarify this point which was made there. This, in any case, this slide will be there with you, this particular presentation, so you will be able to look at it again and understand. Now, after this, of course, we come to the cash flow statement. So we said that we're looking at financial statements, and in these financial statements, we have already looked at the balance sheet, and we have also looked at the profit and loss account. Third thing that we're looking at is the cash flow statement. Now, the cash flow statement, it has two purposes. So it explains the changes during the period. So suppose it is a 1 year period. What is the change in the cash position? This is what it is explaining. And this is very, very important for the business because think of it like this. You can make a profit without having cash. Is this clear to all of you? Do you understand this point? How you can make a profit without having cash? Can someone give me some clarity here? Can we make a profit and still not have cash?
So by considering receivables?
By considering receivables. So basically, if all my sales are credit sales. So just for a moment, let us just go back to this. According to this profit and loss statement, the company has made sales of 10 lakhs. Since it made sales of 10 lakhs, we said that the cost of goods sold was only 6 lakhs. Therefore, it made a profit of 4 lakhs. And all these payments were made. And ultimately, it ended up with an operating profit of 2,39,000. But does this mean that you have cash? The deciding factor is whether you sold the goods on credit or whether you sold them in cash. If you have sold the goods entirely on credit, let's say that these sales of 10 lakhs have been made, but you only have the promise of the buyer to repay you in the future. He hasn't paid you yet. So you have received nothing. But since it has been sold, the ownership is no longer yours. The ownership has been transferred to the buyer. Therefore, you have not received any cash. It is still considered a sale. There is no requirement in the profit and loss statement that you have to receive cash to mark a transaction as a sale. As long as you have sold it, you are showing it as a sale on your books, it is considered a sale and it will be written. This is why when a profit and loss statement tells you that a company has made a certain amount of profit, it is meaningless unless you first try to understand how much cash did it actually receive. Now, as Paresh ji has said, the deciding factor will be the receivables. That means how many people bought on credit. If those people have bought on credit, then now the other thing to remember in receivables, Paresh ji, is that receivables may not only relate to receivables of the current accounting period. Even the previous year's receivables and the year before that's receivables, if they have not been recovered yet, they will continue to be shown as a receivable. This is why to understand whether we made an actual cash, whether our cash position changed during the year or not, whether it increased during the year or not, it is necessary for us to look at the cash flow statement. This is the point which you have to always remember. And this is why the cash flow statement becomes very, very important. The second thing which the cash flow statement does is it classifies receipts and cash payments during the period into 3 categories, either operating, investing, or financing. And these 3 things, if you look at this, it will, if you calculate all this, it will give you a very, very good idea about whether the company has made an actual cash profit or not, or whether the company actually has cash or not. So let's look at the cash flow statement here. So like it says here, this records the cash and cash equivalents that flow into and flow out of the company. So it is divided into 3 sections: cash from operating activities, cash from investing activities, and cash from financing activities. Now, what are these 3 activities? Can anyone recall from the past anything about these things? Shruti?
Cash from operating activities refers to the cash which we either spend or get in by the main core of the business. And investing activities involves of those like purchasing of an asset, reselling of an asset, and financing activities considers of declaring dividend or any other income source of income for that company.
Okay, very nice, Shruti. I think that sums it up quite well. So cash from operating activities, inflows or receipts of cash. So you'll have sales of goods made by the company or services provided by the company. That means when the company makes sales of goods or services and it is paid for this, cash is coming into the company. So since this is the basic business of the company, this is considered as an operating activity. Cash from operating activities will include payments of cash will be payment to suppliers, payments of all heads of operating expenses. Remember, when you make a cash purchase of anything, which is required for the running of the business. In the case of a manufacturing company, it may be raw materials. It could be the amount you pay for labor, the salaries that you pay, the rent that you pay, every single thing, every payment that you make, which you make in cash. Cash, remember, whenever we say cash, we are not only talking in terms of currency notes, we are also talking in terms of making digital transactions through your bank account. So payments to suppliers, payments of all heads of operating expenses, all this means there is an outflow of cash. Sale of goods, that is an inflow of cash. Fine. Then cash from investing activities. So investment refers to purchase of assets like machines, computers, etc. This sort of, let's say, any activity related to these things, the purchase of these things or the sale of these things will alter the cash position. It will change the cash position. If, for example, you buy a machine, there will be an outflow of cash if you have bought it in cash. If you have bought it on credit, and even then the credit amount is, the cash is paid within the accounting year, it is still your cash outflow has happened during the year itself. So even then you will find that the cash has gone out. Then you may sometimes invest in the bond or share of another company. Now, when does a company do this? Can anyone think of a situation? Because this happens quite often. In fact, today I will be giving you an example of one company at least, which is doing this, investing in other companies. When does a company do this? So instead of taking that money and buying an asset or using it for the business, it is taking the money and putting it in, let's say, buying the bond or buying maybe even shares of another company. When does this happen? Yes, Pareshji.
Company has a provident fund trust.
Okay.
In that case, they invest in market.
See, the Provident Fund Trust that you are referring to, Pareshji, that is different from the company. It is the company only deducts the amount of Provident Fund from the salaries of its employees. It makes its own contribution, similar amount of contribution. That amount it gives to the trust, which is running the Provident Fund. Now, the trust is, in legal terms, different from the company. Then the trust actually invests. But the example I am giving you is when a company itself invests in the financial instrument issued by another company.
Investing in sister concern companies?
Okay, so when will they do this? See, there are two things. Sister concern is a very tricky word, because when you are investing in a sister concern company, in India, it is very common to divert funds from one company and put it into another company, if they are sister concerns. And in fact, this is not a very good practice. But since in India, we have conglomerates, one single family running businesses across industries. So the same family will be, like you take someone like the Ambanis, or you take the Birlas or the Tatas. They have a huge range of businesses. And these people, they do a lot of investing in each other's companies. So to that extent, Pareshji, you are absolutely correct. Is there any other reason for this, apart from sister concerns?
For
See,
expansion?
Yes, Shruti?
To expand, maybe?
No, there will be no expansion. No? You are just taking the money and you are buying, let's say, bonds issued by some other company. See, the thing is, any company which has a lot of extra cash, extra funds, it is very cash rich. it will have to put those funds into something which will earn. Let's say that they don't need to further expand their own business. Today, we will see one company like that. Then such companies, what they will do is that they will take the company, they will take the cash and they will invest it in something else, in the bond of some other company. Maybe for a short term, they may even put it in a mutual fund, liquid mutual fund, the ones we had discussed when we were doing the mutual fund unit. They can do that also because they cannot let the money remain idle. That is one. Now, the next thing is sales of these assets will lead to an inflow. So the sale can be of any of these assets. The sale can also be of the bond or share which the company had bought. So in that case also, there will be an inflow of cash. So when they actually invest, there is an outflow. When they redeem those investments, there will be an inflow. So that is one part. And then, of course, there is cash from financing activities. So whenever they take a loan from a bank or from bondholders, other creditors, there is an inflow of cash. So please don't confuse the creditor here with the sundry creditors, which is the payable type of creditor which you see in the balance sheet. That is there, they are giving you goods, no money is coming. But when we say loans, financing activities, we are referring to a loan where actually the bank account of the company is being increased because of the amount credited by the bank which is giving the loan. Similarly, when interest on these loans are paid, or when the loan itself is repaid, there will be an outflow of cash. So basically, these are the three things which affect the cash. So after I have made my profit and loss account, I should then make this to understand how much cash do I actually have. Once I know this, because this is what makes the difference between a company which is doing really well and a company which is not doing well. Remember when we were looking at equity, different ways of identifying companies for investing in equity, we were looking at this particular parameter, and we found that many of the good companies that we saw, we looked at Relaxo, we looked at Asian Paints, we looked at Dr. Lal Path Labs. In all those cases, we found that their cash was growing on an yearly basis by almost 20%. So the free cash flows of the company was doing very well. And that free cash flow is basically this. You take all these and you add them up. So the next slide that we have here, this is the direct method. So we take first the operating activities inflows and the operating activities outflows. So let's say that cash received from customers is 10 lakhs. Cash paid to suppliers is 2 lakhs. Salaries paid is 150. Operating expenses is 50. Net cash is basically 6. That means these 2 lakhs plus 150 plus 50 is equal to 4 lakhs. 10 lakhs minus 4 lakhs, you're left with. This cash is there with you. It's there in your bank. So looking at this, you can very easily see that this company has not made too much of credit sale. The receivables are not going to be very high. They have received a good amount of cash. Then investing activities. Let's say that they sold land. If they sold land, there will be an inflow of cash. They have purchased a machine, let's say. There has been an outflow of 6 lakhs. So it comes here. Net cash from investing activities, if you just take these two, you will find that the company has actually, the outflows are more than the inflows, and they have about 1 lakh short. It's 1 lakh has gone out. In the financing activities, let's say that they have paid dividends. If they pay dividends, then obviously there has been an outflow. The company makes profits. From the profits, a certain amount is paid as a dividend. So That again, 1 lakh is an outflow. And they have also repaid a loan to the extent of 50,000. So that again is an outflow. So the net cash from financing activities is again 150,000 of outflow. So we have one outflow here of 1 lakh, one outflow here of 150, 250 has gone out, 6 has come in. That means the total amount, if I want to know how much cash this company actually is left with, it is basically what? 6 lakhs minus 2 lakh 50,000, which gives you 350. This amount has flowed into the business. Is this clear to everyone?
Yes, sir.
So if you find that during the course of the year, more money has gone out, less money has come in, and at the end of it, you do not have, let's say this is going into a negative balance. This means that you are not in a position to pay dividend. You are not in a position to go for expansion because you do not have any cash. This is the biggest problem that you will face. So this point this is something which you have to always remember. Okay. Now, after this, now we will do two things today. And to do this, we will basically take the help of the Excel sheet, because to explain this, so note the word here, analysis. What we are doing is, we want to equip ourselves with a tool with which we can analyze different companies. Analyze the company itself based on its work done over the years, number one. And number two, if we want to compare this company with another company, we also can use this method to actually analyze. So when we do this, we use something called a common size analysis. Has anyone heard of this?
Yes, sir.
Shruti has heard of it. Okay, good. Paresh ji and Praveen ji, maybe you have not actually gone.
No, sir. No, sir.
No problems. So we will try to understand this properly, so that okay, tell me one thing, Shruti. What is the purpose of a common size analysis? Let me test your knowledge of this. Shruti?
Yes, sir. In common size, if I'm not wrong, then in each year we compare the value of each and every asset or liability with their total, or in case of income statement, with their revenue from sales.
Okay, fine. So what Shruti is saying is correct. So just try to remember what she said, and later on when we go through these next 2 or 3 slides, you can see whether she was wrong or whether she was right. Broadly speaking, she has said the correct thing. So now let's try to understand this. When we look at a normal balance sheet or a profit and loss account, what we basically do is, each item that we see, like for example, the sales figure, the cost of goods sold figure, each of the operating expenses, the profit figure, every single thing is expressed as a figure, an actual amount. So 500,000, 200,000, these figures will be there. Now, in the case of a common size analysis, everything becomes a percentage. The first thing to note is, everything will become a percentage. Now, when we actually look at the Excel sheet, you will understand why that percentage helps. The second thing which happens here is, it helps us to compare different companies with entirely different figures. Suppose I am comparing 2 companies. and the size of the companies is different. One is fairly big, one is not that big. But I still want to understand which of these two companies can I consider to be more efficient, which is making better use of the resources that it has, which has a better profit margin. If I want to look at all these things, I have to use something other than the figures. If I look at the figures, then I will get just two sets of figures, and I will simply assume that whichever company has the larger figure is the one which is doing better, which may not be correct. So this actually, for example, think of a company X that has sales of 150 million. So it has made sales of 150 million, and it has cost of goods of 120 million. 15 crore, 12 crore. There is another company, let's call it Y. In that case, they have sales of 80 million, and the cost of goods sold is 48 million. Now, if I want to understand which of these two companies is more efficient, which is actually managing to make a greater percentage of profit, then looking at these figures alone, I will simply say that this company with 150, it was able to make 30 million in profit. This company with 80 and 48 made 32 million in profit. But how much better is this company Y as compared to X? That I am still not able to understand. To understand that, I need to work with a common size statement. That is one. So if I reduce it to percentages now, what I find is that if I take 150 and 120, so I can see that the percentage of cost of goods sold to the total sales is 120 divided by 150, that is 80%. But in the case of Y, the cost of goods sold is only 60%. The other 40% is its profit margin. In the case of the first company, cost of goods sold was 80, 20% was the gross profit margin. In the case of this Y, we are getting a 40% margin. So it is actually double, doing almost much better than the first company. Though the first company actually has better figures. So common size analysis will allow you to reduce all companies into one common parameter, percentage. And then we can judge how these companies have actually performed on the basis of these percentages. So what we are going to do is, we will look at two companies, both of which are very well known. One, of course, will be Colgate-Palmolive, and the other will be Marico Limited. Anyone knows what Marico Limited makes? Can you think of one product? I'm sure you will be using this product also, but maybe you have not thought of Marico as such. Does anyone use coconut oil?
Yes, sir.
Yes, sir.
Okay, so which brand?
Parachute.
Parachute? Okay, good. So, and Paresh ji and Praveen ji, what about you?
So Parachute.
Parachute. So Parachute is made by Marico, right? So just to understand that they have a very good product, and they make, Marico also makes a large number of other products, including, let's say, Saffola. That's another Marico product. Many more of that type. But all I'm trying to tell you is that I have taken two consumer goods companies, and we will look at how to compare these. Obviously, Colgate-Palmolive is much bigger. So if I now want to see this in form of a common size statement, so a common size balance sheet of Colgate-Palmolive, here it comes. First column A, this is the actual figure in financial year 2013. Here in column C, you have again the actual figures for the financial year 2012. So we have two of these here. And column B and column D have taken these figures and made them into percentages. Now the thing here is, how have they been reduced to percentages? I'll tell you here, and then what I want you to do is open the worksheet which I sent you and try to do that exercise and see if you get that correct. So that way what will happen is you will absolutely understand how to be. It's a very simple exercise. See, how do I, when I say percentage, it has to be a percentage of something. So I'm saying cash and bank, which actual figure is 4,288, is a percentage of the total assets. What percentage of the total assets is cash and bank? How will I find this out? I will take 4288 and I will divide by the total assets 13067 and I will multiply by 100. So what I will get will be a percentage. So if I do this calculation, I am going to get 32.82%. Now, if I want to find out what is the percentage for, or what is the common size figure for accounts receivable, then I am going to do the same thing. I'll take this figure, accounts receivable figure of 812, divide by total assets, multiply by 100. So I get 6.21. Loans and advances, I'm going to do the same thing. Same thing for inventory, same for current assets, fixed assets, other assets, and total assets. And I'll get all these figures here. The same exercise has been also done for FY12. And the same exercise has again been done for the liabilities, which are coming here: accounts payable, other CL and provisions, current liabilities, long-term liabilities, net worth, total liabilities. So since total assets and total liabilities are the same, basically what we are doing is we are dividing by the same figure. So if I want to find out what is the common size figure of accounts payable, I will take this figure 4666 and divide by the total of liabilities, which obviously is the same as the total of assets. So 4666 divided by 13067 multiplied by 100, I'm getting this figure here. Now, if I look at, suppose you look at only this company and you compare these 2 years, FY12 and FY13, from a balance sheet perspective, what I can see is that the cash has increased by almost, figures are in millions. So if you reduce this by 1, let's say 3098 million is equal to 309 crores, roughly 310 crores. So it used to have 310 crores in the bank. This has gone up to 429 crores in 1 year. Now, if you look at it from a percentage perspective, you can see that as a percentage of assets, it has actually increased by more than 5%. So that means this company is getting more and more cash. It is a cash-rich company. It's getting more and more cash, and it doesn't know what to do with the cash. The cash is lying there. This is one thing which you can see. Accounts receivable, you can see here, it has more or less at the same level, 87 crores, 81 crores. If you look at percentages, it is slightly down. It has come down by roughly 0.5%. So this is one. Now, accounts payable, if I see, I can see that accounts payables are actually increasing from 32.67% to 35.71%. What does this mean if accounts payable are increasing? Anyone?
More liabilities.
Don't think of it that way. Yes, payable is a liability, so more liability. That way, you're technically correct, Pareshji. But think of it like this, that Colgate Palmolive is getting more and more credit from its suppliers. Wherever it is buying something, it is buying mostly on credit because the company is so big that nobody wants to say no. If it says that, look, I'm not going to pay today, I'll be paying 30 days down the line. Nobody has the guts to say that we will not pay because they are placing such huge orders. It is not possible for the supplier, so they sell so many consumer goods. It is not possible at all for anyone to say that, no, we will not actually give you. So they are squeezing their suppliers and they are getting more and more credit. This is an easy source of finance for them. This part, this you can see this very clearly, and you can also see this other assets, 821, 1311. Can anyone tell me what these other assets are? See, you have fixed assets, you have current assets, inventories, etc. What is other assets? Because this will tell you a little story about what is happening here.
Patents and other fictitious assets.
Actually, those are intangible assets, what you are referring to, Shruti. Other assets here is basically referring to, you can think of
Advance.
them as, yes?
Hello. Any advance or prepaid expenses, sir?
Prepaid expenses will be there, but apart from that, these are also investments. These are also investments which the company is making. And what it is doing is that it has so much of extra cash that it is actually using the cash to make small investments in other, let's say in other financial assets. Whatever it finds is good, that it is doing. And the loans and advances, as you can see, is coming down. So their borrowings are very low, but their cash is very high, and they are actually using the cash to basically invest in other financial assets as an additional source of income. So they don't need to use the cash that they have for any expansion purpose. Okay. Now let's look at the other common size for Colgate, but this time we are looking at the income statement. Now, if you look at this, basically, when I say that other income is 499, this is 1.5% of what? So the base figure for all these calculations is total sales. So what we are trying to do is, we are trying to find out what is the percentage of each item, keeping sales as my base figure. So what percentage of sales is other income? It is 1.58%. What percentage is cost of goods sold to sales? It is 39.51%. That means you can see the margin here. So something which is the cost is 12,500 is sold for 31,638. 60% is the margin out here. And you can also see that the cost of goods has actually, as a percentage of sales, this in fact used to be even less out here, 33 only. So it has gone up to 39 over these 2 years, but it's still a very, very low figure, giving the company a very, very good margin. You can see the gross profit margin here, 62% here, 68% here. So this is a big multinational company having excellent brand loyalty, millions of customers all over India actually buying their products in malls, in shops, in villages, everywhere. And the result is that they're getting a gross profit margin of, which is as high as 62%. Then look at the sales, general and administrative expenses. This is very high. So
I have one
40%.
question.
Yes.
This total sale and cost of goods sold. Why there is a difference? Actually,
No.
sales means it should be cost, no, final cost of goods sold. This should be similar, same.
No. Cost of goods sold is your production price. Sales is your selling price.
Oh, right. Okay.
Okay. Cost of goods sold is the cost what did it cost you? So look at, see, we are buying it from the company is getting a 62% margin. At least in 2013, this was the margin. In 2012, it was 68. They are getting that sort of a margin in the sale. It is that high. And the other income also, you can see, this other income is basically coming from the other assets. In the balance sheet, we saw that other assets column. This other income basically is coming from there only. Now, selling expenses, general and admin expenses are very high. You can think of different reasons. Advertising costs are there. There are so many dealers to be taken care of, so many employees and all that. I think that is one reason. At the end of the day, the profit before depreciation, interest and taxes is coming to, the margin has gone down to 22.38% here. Look at the amount of interest that they are paying. It is ridiculously low, 13. Only 13 million has been paid as interest. Basically, this company is almost debt-free. You can see from this. Depreciation and amortization is 437. So it used to be 1420. Even this has gone down. Depreciation, of course, is what we just saw, the amount which is charged on the assets every year. Amortization is the same thing, but it is charged on an intangible asset. For example, if I have bought some software, I'm treating that software as an intangible asset. Here also, I have to keep reducing the value of the software every year, just like I reduce the value of a fixed asset. So when I reduce the value of the software, I pass the same type of entry which I passed in the case of depreciation. I will have the same sort of fixed asset. I had that fixed asset account for the machine, 10 lakhs. Suppose you had bought software of 10 lakhs, you will have a similar account. Let's say you bought software for 10 lakhs, same 10 lakh entry will be there. If you are saying that the software has a life of, let's say, only 5 years, every year you will write off or depreciate 2 lakhs. But in the case of software, since it is not a tangible asset, the word which we will use will be amortization. It is just a difference in terminology. It means the same thing. So is that part clear to everyone?
Yes, sir.
Yes.
Okay. Then this is the amount of tax, and profit after tax comes to 4968, which is about 15.70%. As you can see, this is much better than the year previous. The dividend that they have paid is 12% on this. So these are actual figures for 2013, actual figures for 2012. I have reduced this to common size out here. Now what I am doing is, I am giving you the same 2 sets of figures, but now I am giving it to you for Marico. So if I take Marico, what I have done again, I have taken the Okay, now can someone tell me what this percentage is here? 7.19%. How do I get this?
Cash and bank upon
Divided by
total assets.
totals.
Yes,
Cash and bank upon total assets. That is
cash
a
and
percent.
bank upon total assets. Accounts receivable,
In the same way, sir.
this will be in the same way. Perfect. So we have this also. So basically what we have done is we have managed to reduce each and every item of Marico to these particular percentages. Now, if you look at Marico out here, you will see that the cash and bank level is much, much less than in the case of Colgate. So whereas in the case of Colgate, we saw that it was 32%, 33% of the total assets. Here it is only 7% of the actual assets. So basically, what we are seeing is a company which is not as cash rich as Colgate. That's one straight takeaway that you have out here. The second thing that you can see is that the receivables are decreasing, which means that they are not making credit sales. They are reducing the amount of credit sales that they have, because they used to have almost 8% of credit sales, and now it has come down to 5.30%. So whenever we see receivable, we should understand that this means that the company has made sales, credit sales. It is still to receive the money. At least as on the date of the balance sheet, this money was still receivable. Loans and advances, as we can see, this again has come down, which is a good feature, from 13 to 7. Inventories have also come down out here. Current assets, there is a small mistake here. This actually should be 15892. I have corrected it in the next slide. So just a minute. I can correct it here also. Actually, this is 2, and this actually is okay. So we can see that current assets have come down. That's mainly because of inventories, I think. And fixed assets have gone up substantially. Other assets, you can see, are more or less at the same level. Now, if you look at accounts payable, you can see that this actually is increasing a little. It used to be 3584, but it has increased to 4785. But as a percentage of the total, it is less. So to that extent, one conclusion that can be drawn is that maybe the company is getting less credit from its suppliers. That is one.
Hello? Yes, sir.
Yes, Praveen.
There is a confusion, sir. These all percentages should be equal to 100, no, sir? Total of data. That is cash and bank, accounts receivable, loans and advances, inventories, current assets, fixed assets. That should be equal to 100%.
No. It won't be equal to 100.
Okay, their total should not be equal.
It won't be equal to 100. Basically, it will just give you the percentages of these things. Because in this, there are overlapping. Some overlapping is there. So it will not always be correct.
Okay. That is only doubt, sir.
That's all. So this is one. Now, if we look at the income statement and we do the same exercise, so here, how have we got this figure? Other income 0.82.
Other 375 divided by 45962. That is other income divided by total sales into 100.
Yes. So in this particular common size statement, what we are doing is we are using the total sales as the base figure. So every single item here is seen as a percentage of sales. So when I do that, I am able to understand which items are actually increasing. So for example, cost of goods sold here, I can see that it is actually, it has improved for Marico. It used to be 61%, it has gone to 56%. So their profit margin has actually increased. It's very clear out here. I can also see that there has been a slight increase in the sales, general, and administrative expenses over here. We see that the profit before depreciation, interest, and tax, that has increased from 12.82 to 14.94. And we also have interest of 580, 1.07, 1.26. So 580 million is being paid as interest. Now, if you compare this with Colgate, you remember the interest which Colgate was paying was only 13 million. Look at the difference here. So this company, you can see, is not as cash rich as Colgate there. Depreciation and amortization, 1.88%. Tax is there, and then you are getting a profit of 3959. If you look at this level, it is 8.61%, and which is an increase over the previous years, 3171. So now what we have done is we have looked at we have converted everything to common size. Now, what I want you to do now is we will make a comparison of these two on this sheet. But we will do this just after the break. So it's 7 o'clock now, 2 past 7. We'll just take a 5-6 minute break. I'll be back after that. And then we'll begin to see why this common size helps and how it helps us to actually analyze the performance of two different companies, which have different levels, where the size of the company's operations are absolutely different. But when we reduce it to a common size statement, we can actually see which company is doing better. Okay, so I'm just taking this short break, and we'll be back in about 5 minutes. Okay, so before we start again, just wanted to ask, is this whole section clear? Are there any questions? Is there anything that you would like to actually ask regarding this? Tanya, are you there?
Yes,
Can
sir.
all of you, Shruti, you're there. Paresh ji, have you come back?
Yes, sir.
Okay, Praveen ji. I think Praveen ji is coming. And Tanya? Okay, doesn't matter.
Yes,
I'm sure you're here. Did you understand what happened today, Tanya? Is there any part which you're not understanding, any difficulty anywhere?
So actually, today I'm at a very crowded place, so I would listen this lecture very slow and easy.
Okay, so today on the WhatsApp for our group, I've also sent you an Excel sheet. So in a little while, I'll ask you people to open that Excel sheet and just do that simple exercise so that at least this common size thing is absolutely clear in everybody's mind. And after that, we will go for the next part, which is basically the another analysis form. So now look at this. What we have done is, in the earlier slides, we had done the common size for a balance sheet of Colgate, Palmolive, and for Marico for FY 2013, and we had done it also for FY 2012 for both these companies. Now you can see why it is called common size. Now when I put the figures here, I can see that the position of these two companies, they are on an equal footing now because we are now looking at it in percentages per 100. So it doesn't matter how much your sales are or how much of, let's say, capital you have, what your total liabilities and assets are. Those things don't matter. Now we are only looking at it in terms of how you actually use the resources that you have. Now, if you look, you can see what has actually happened very clearly for these 2 years. Actually, this can be even more interesting if we take 4 years of data, but it was a little hard showing everything here. So I compressed it to two and did it like that. So now look at this. Cash, whereas Marico has only 7%, these people have 32%. But one thing you can see that both of these have increased. This has gone from 5 to 7. Colgate Palmolive has gone from 27 to 32. Accounts receivable, here again you can see that they are more or less around the same lines. There's not too much of a difference. Both companies are, let's say, good enough to avoid giving too much credit. So they have enough weight. See, if your products are good, then people will buy it even though you are not giving credit, or even if you are giving very short credit period. Even then, people will be willing to buy it from you. So with products like, let's say, Parachute here and Colgate there, this is bound to happen. And I think there is a certain amount of loyalty that consumers develop with these products. Now, if you look at loans and advances, that again you can see is for both, they have reduced the loans and advances that they are actually giving other people, this part. If you look again at inventories, you can see that Colgate Palmolive has only 14%. They have 23%. What does this mean actually? What do you think this means? Marico seems to have a very high level of heavy percentage of inventory. As against that, Colgate Palmolive has low. So which is better? Let's start here. Which do you think is better?
Low inventory is better.
Low inventory is better. Okay. Then my next question is, does everybody understand why low is better? Can somebody explain? Tanya, do you understand why low inventory is better than a high inventory? Shruti, maybe you can clarify this a little.
Yes, sir.
Hmm.
Um, Sir, low inventory means that the company, whatever it's producing, it is able to sell that. And in case of high inventory, it means that whatever it has produced, it is not able to sell that, and it is kept in their warehouse.
So that means that more money is locked away in inventories. More funds, because till it remains an inventory, up till that point, it has not been converted into cash. It is just lying idle. So the money is blocked. So it is a current asset. So inventory is considered to be an asset, but it is not liquid. It is getting blocked up. And if the amounts are very big, then that much funds are tied up in inventory. So you may have heard of the concept of something introduced by Toyota known as just-in-time inventory. Has anyone heard of this? Just-in-time inventory. So this is a concept which Toyota introduced, which they were able to reduce their inventory to 1 day raw material consumption, to 1 day of consumption. And how did they do this? They basically put pressure on their suppliers that, look, this is the amount we consume on a daily basis. What we want you to do is provide us with the raw material or whatever component you are giving us on a day-to-day basis. We are not going to pile it up. We are not going to block our money in inventories. We want to keep our money for better stuff. As our supplier, if you want to continue remaining a supplier, you give us the amount, whatever you're selling us, give it to us only for 1 day. So, and in fact, in some cases, it has been reduced to hours. So that is the ultimate, where the inventory levels are so small that the company is confident that it does not need to keep it in stock. That is the best. Now, by those standards, you can see that Colgate-Palmolive is doing much better than Marico. And the reason for this is that a lot of the production which is done by Colgate-Palmolive is done through a process called contract manufacturing. Are you people aware of this, contract manufacturing?
Yes, sir.
Yes, sir.
Okay, so anybody, please explain what it means.
They ask somebody else to manufacture on behalf of them.
Yes, so a different
Toll
company.
manufacturing.
Yes, so basically they will manufacture on their behalf. That company will maintain the inventory. Colgate will basically take what it requires from them whenever it requires, and it will sell that. So because of that, they're able to reduce it. Now, against that, Marico has a different concept. Marico basically wants to produce everything itself. So because of that, they have to maintain a higher level of inventory. See, the other thing that this, remember, is that same error. Now, I'll fix this. This is that, just a minute. So if we look at current assets, here again, you can see that this Colgate Palmolive seems to have a very high level of current assets. As compared with that, Marico has less. So it basically depends on what current assets you have. Now, we've already seen that in the case of Colgate, probably the reason for the higher assets is this very heavy cash and bank balance that they have. That is actually the reason, because this would actually be in the current assets section. This also answers your question, Praveenji, when you said that why does it not total up to 100? Because these are overlapping items now. Current assets here includes cash. So when if you want to total, it will obviously not come to 100, it will be more because they are being repeated. So, but these different components are shown to give us a greater clarity about how these companies are actually performing. Then we come to accounts payable, and you can see this trend here, where Colgate Palmolive is actually squeezing its suppliers to give it more and more credit. So the amount it is buying on credit is actually increasing from 32.67% in 12 to 35.71% in 2013. You can also see that long-term liabilities, these are basically the loans that the company has taken, is very, very low, only 2.73%. And this is why, as you remember, the amount of interest that it had paid was also only 13, which is again very low. So what we can see here is that when we use a common size balance sheet to compare the performance of two companies, it becomes very, very easy to do this. And the same comparison can be done again for the income statement. So here again, we can see where the the differences are. So first of all, we see that the gross profit margin itself, there is a huge difference here. 44.62, 39.68. So much more efficient out here. So they are managing to get such a high profit margin out here. We also can see that Marico is able to function with a lower level of expenses. This goes to the credit of Marico. It appears that the sales, general and administrative expenses of Colgate Palmolive, you can see, is very high. But despite that, they are able to get a profit before depreciation, interest and tax of 22.34%. Interest is negligible, only 0.04%. Depreciation or amortization, 1.38%. Tax is 5.26%, and profit after tax, as you can see, is 15.7, which is close to double that of Marico. So this is the basic purpose of having a common size statement. Now, what I suggest you do is just open that Excel sheet, spend 5 to 10 minutes, and just tell, and then I'll check with you to see whether you have got this calculation correct. Is that okay?
Yes, sir.
You have your laptops with you, you have the sheet with you. Just see whether you can make a common size balance sheet and a common size income statement based on the figures that I have given you. Can you do that, please?
Yes, sir.
This is what you should have received. This is what I had sent all of you. This particular sheet here. So if you can just open this and just see, I just want to understand that you have got this common size thing, like clearly in your mind, and then we'll go into something called index-based analysis. Praveenji and Pareshji, do you have your laptops?
Yes, sir.
Okay, so Praveenji, just try to do this exercise here. So why I am, like particular about asking you to do this is that one assignment which I am going to give you people after some, like once we finish this unit, is to actually pick two companies and do a common size based analysis of those two companies and come out with your conclusions. And number two, also do an index based analysis. That index based analysis we are going to do just after this.
Done.
Done. Very good. Use the dollar formula.
Yes, sir.
With the dollar formula, it becomes very easy.
Done, sir.
Done? Okay. Praveenji,
Yes, sir, completed.
completed. Okay. So let me just show you the solution to that. You can all compare and see whether it is correct or not. So So just compare. Are you getting these figures?
Yes, sir. Received.
Got it?
Yes, sir.
Okay, and this is for your income statement. I think, is there anyone who has any issue with this? Is it clear, the whole concept?
Yes, sir.
Okay, Praveen ji,
It's clear, sir.
Paresh ji has also done it, so it's clear to you. So this
Yes.
common size balance analysis is one way of actually analyzing statements. So what we will do is, we will use this common size analysis. The assignment which you will have is, you will have to pick two companies. You get their figures from money control. You will be able to get it directly from money control. You can copy paste it in Excel. It's not a problem at all. And you pick two companies from the same industry. And you take figures for 4 years. It will be very easy to do this because the entire thing will be available there. What you do is, then you convert it into a common size balance sheet and a common size income and loss statement. And then what you do is, you try to analyze this. If you can do this, then I will say that a large part of understanding financial statements, that part is done, and you are in a position now to take simple balance sheets, simple profit and loss accounts, and analyze them and make some sense out of them, what is happening. The other thing that will help you to do this for one company, if you just take one company and try to do this, is something which is known as index based analysis. Now, in the case of index based analysis, what we do is, let's say that we have, let me just try to use this. All of you can see this Excel sheet now. You can see the figures here, not a problem.
Yes, yes.
So in index based analysis, what we basically do is, we take one base year. Let's say that we are doing between the years 2010 to 2013. Now, I want to understand that between 2010 and 13, if I take 10 as my base, how has the company actually performed with respect to different heads? What that tells you is, it will tell you a lot about the strategy which has been adopted by the company. So what I will do is, just to convince you that there is a lot of material which can be drawn from an index based analysis, I'll try to send you some material after this class, maybe tomorrow or day after, from a very good book which I found, which was analyzing these two companies. And you can look at the amount of detail which they have managed to get from an index-based analysis. Now let's take this index-based analysis here of, so let me just show it to you in the PowerPoint first. If this is visible, then I don't need to go to PowerPoint. So is this clearly visible, all of you?
Yes, sir.
Okay. Shruti?
Yes, sir.
Okay. So let's say that these are figures which we have from, this is an extract from the balance sheet, asset side of Colgate-Palmolive India Limited. So I've taken the figures for 4 years, 10, 11, 12, and 13. Now, if you look at cash and bank, you can see that it was 3476, and you can see these different figures. It is coming here. You can see the same for accounts receivable, loans and advances, inventories, current assets, fixed assets, other assets, and total assets. Now, in an index-based analysis, what we are expected to do is we will take, let's say, one of these years. Normally, if I have a certain range of data, the earliest year I will take as my base year. So let us take, for example, this particular year, 2010 out here, as my base year. This I will call my base year. Now, I want to convert each of these three, into percentages, keeping this as my base. So if I want to know, for example, cash and bank of 4288, what is it in comparison with what it was in 3476? A cash balance into 12 of 3098, what is it in comparison with the year 2010 when the actual cash was 3476? And I want to do this for each of these 3 years, for each of these heads. So this particular base year is my index, and I am doing it here like this. So this is, I call this 100%. This is 114%. So how do I get this figure? What I will do is, I will basically do this. I'll take this. Suppose I want to find out what this is as a percentage of this. What am I going to do? I will take this 3951. I will divide it by 3476. I'm getting this here. I will convert this into a percentage. So what I get is 114%. This is my percentage here. If I want to find out what this is, I'll do the same exercise, but this time I will basically take this figure and divide it by this figure. I'll get this, and I convert it again into a percentage. So I'm getting this 89. And if I want to do it for the year 2013, I will again do the same exercise, take this figure here, divide it by this figure. I get my division here, and I convert it into a percentage. I'm getting 123%. Now I do the same thing for each of these items. So when I am comparing 812, I will compare it with 98. When I am comparing loans and advances of 977, I will compare it with 1228. Similarly, when I'm comparing inventories, I'll compare that with this figure here. So basically what will happen is I will be able to get a very good idea about how this company has actually moved from this particular base year. So now suppose I show you this figure here. So what we can see is, let's take each of them. We can see very clearly, and this will give you a completely different perspective of, you have seen these same figures as actuals. You have seen them in terms of common size, but now you will see how the company has actually moved. So when we look at cash and bank, we don't see something which is very drastic. So we see that if I take 210 as 100, I went up to 114 in 2011. I went a little down, 89 in 2012, and I went up to 123 in 2013. One thing is very clear, that it is increasing, the cash and bank. But look at this, accounts receivable. Here, the company is actually, there is a 8 times difference in its policy. Whereas, whatever was the figure in 2010, they are doing it 8 times to that extent here. And this, you can see this very clearly here. There is a change of policy which has taken place, where they decided to give more credit. And this is also the period, in the analysis I was looking, I also was very curious. What do you think is the reason for this? They are suddenly beginning to give so much of credit. Why do you think this has happened? Anyone? Any thoughts why the accounts receivable should have gone up by so much?
Credit sales are more.
Yes, that is very clear. Accounts receivable means that credit sales are more. But what you are seeing, Praveen, is that between 2010 and 2013, the company has absolutely changed its credit policy, where it has given 8 times more credit here in 2013 as compared with 2010. 8 times. That's why it's 829%. So something has happened which has absolutely changed the way the company has begun. Because the company, obviously, when it is giving so much credit, one of the reasons for this is to push up your sales. So they felt that giving more credit can push up my sales. But at the same time, they were very confident that whomever they are giving this credit to, these people are capable of paying back within the credit period. Let's say they gave them 30 days. You pay us back after 30 days. This company, Colgate-Palmolive, was very confident that that company, that buyer, will actually pay it after 30 days. It was very confident of that, and that is why it allowed the credit. The other thing to think about is that particular buyer or that group of buyers which were there, they also were, let's say, powerful enough to negotiate with Colgate-Palmolive and ensure that they gave them credit. See, otherwise, a company like Colgate-Palmolive, which has such huge brand loyalty, where so many a large number of customers are there everywhere, there is a huge demand for their products. Despite that, in 2011, they are forced into making credit sales. Remember when we said that when we make more credit sales, the cash inflow reduces. And when the cash flows come down, my profit is a paper profit till I get my money back. So it is a big, big decision to be made. Should I give credit? Should I not give credit? If I don't give credit, obviously this company felt that in that case, our sales will substantially come down. So we have to give credit. So I'm giving you some hints here. It has to be a big player on the other side or a set of big players. Who can these people be? What changed and made the company, think about this all over again?
Maybe competition.
See, Pareshji, one thing is very clear. Competition is there. Competition is always there. That I don't disagree with. But think who can be such a person who can force someone like Colgate Palmolive to give them this amount of credit. What sort of player do you need?
Distributors.
See, the distributor system was there all throughout, Praveen. That has not changed. Even before, when, let's say, these Colgate Palmolive was selling, and they are selling everywhere, they used to be distributors. They are selling in rural areas. Obviously, they will have distributors. But the distributor is never in a position to arm twist the company into giving them too much credit. Because the distributor is, after all, a very small person. When you compare him with the strength of such a big company, he's a small guy. He can't really arm twist you. Who can arm twist you? Today's class has been all figures, so I thought I'll ask you this, this little problem, so that you can think about it.
After manufacture, there is a wholesaler, sir.
तो यार वो wholesaler तो है ना प्रवीण जी, वो तो पहले भी था. Do you think a single wholesaler sitting in Pune or in any part of India can be strong enough to, they will say, okay, theek hai, you don't want to sell my goods, I'll appoint another wholesaler. You can go and sell somebody else's goods. You go and sell Marico goods. I will appoint my own wholesaler and they will take it from me. And anybody will be happy to be a wholesaler for Colgate, because whatever they buy from Colgate, that is bound to sell.
Then the finally product demand is there only.
Sir, maybe these big malls.
Paresh ji has got it. This is the answer. So, something like Reliance Mart, Big Bazaar, Easy Day, these people, they are people who are buying in bulk. They are buying in bulk because they also have very huge sales and regular sales. So because of that, during this period, those people have begun to, make their presence felt all over India. All these chains have opened shops in most of all the big cities. I think even in the tier 2 cities, everywhere you will find these people are present. And it is because of them mainly that you have a position where a company like Colgate also is willing to give them credit. So you can see how a Reliance Mart will function. It will buy things from companies like Colgate on credit, and then it will sell that to us for cash. They have, by the time they will practically sell the goods to us, take the money, and then go and pay Colgate. They will not even involve their own funds. This is the lesson which you can see. So when two big players are there in the market, this is how it works. And this is why we are seeing that smaller players are finding it more and more difficult to actually cope in these times. So one thing about capitalism is that the big tend to become bigger. And as they become bigger, smaller people find it more and more difficult to survive. And some of them actually close down. So as more of us find it more convenient to go to, let's say, malls to do our shopping there because everything is available under one roof, who is the person who suffers? It is that small guy, the small shop we used to go to many years ago. So because of, and these all the big players, they have this facility. They are able to arrange finance for themselves out of practically nowhere. So they are getting these finances. They have an excellent cash flow. All inflows are coming in. Practically speaking, the inflows are coming first and the outflow is happening after that. So this is something to think about. We can see that if you look at, let's say, loans and advances. So these are basically loans and advances given by the company to someone else. It's an asset. No? So this is not a loan taken by the company. This is a loan given by the company to another person. It could be maybe to help one of the suppliers that it has. It could be for some other reason. But basically, you can see that this proportion has come down a little from the 2010 level. They're doing less of this. Inventories have increased. So we saw that when we looked at a comparison between Marico and CPIL, we saw that inventories actually were less in CPIL. But within Colgate, we see that actually inventories have increased from the 2010 level. So they used to keep less inventory in 2010 as compared with now. But maybe that's also an indication that sales have increased. Current assets, as you can see, have actually increased. Why do you think current assets have increased? See, this is a test for you. The answer is on this page.
Due to account receivable, sir?
Yes, yes, absolutely. Basically, the two things which are driving the current assets here are, one is accounts receivable and the other is cash. Because of these two things, you can see that current assets have actually increased. Fixed assets, of course, it is a different, it has nothing to do with this section. The fixed asset part is basically something which they need for the long term. So that is there. But you should look at other assets. This is what I was hinting at when we were looking at this earlier. In other assets, as you can see, it has tripled since 2010. And according to what I read about, in the analysis, this is basically because they are using the extra cash that they have to invest here. So basically, Colgate-Palmolive, it is cash rich. Despite the fact that they're giving so much of credit, they still are cash rich. And they are using that cash to invest in, create other small assets, mostly financial assets, which is giving them an income which is being reflected in other income. That is being reflected in the profit and loss account in the section called other income. So this is the concept of an index-based balance sheet. So we can do the same sort of analysis for the profit and loss statement also. So let me just come back to the presentation and we will. Okay, so now we understand index-based analysis. We also understand common size analysis. And what I would like you people to do, I'll put the entire, I'll put this officially on WhatsApp. But this is an exercise which I insist that all of you should do, and you should send it to me in Excel. You can pick any company that you want. I have no problems with that. Pick any company that you want, 2 companies. Pick them from the same sector. So for example, if we are doing, let's say, FMCG, fast-moving consumer goods, then you can pick 2 companies here. If you are doing some other sector, let's say we're doing paints, you can take it from there. If you're doing footwear, you can take it from there. Anything. You pick 2 companies, the balance sheets and the profit and loss statements. All these are easily available in moneycontrol.com. Go there. So basically what you will do is you will go to Google, you will just write profit and loss statement, write the name of the company. It will take you directly to the, it will give the first, after the search is done, probably the first item you will see there in the search will be the money control one. Go there, open it, download that particular Excel file, You will get the data. From that, you get the take about let's say at least 5 years data, convert it into common size, also convert it into index based, and then try to do an analysis and see what happens. See, what will happen is that you will have the confidence to actually understand the working of these companies better. Some questions will come in your mind. Why did this happen? Why did that happen? We may not know the answers to all those questions. But the fact that you are asking the questions about a company means that you understand it better. That is my main objective. If you can do that, then you're doing well. And we will also do a bit of ratio analysis. And with that, we will be able to complete this section properly. And we'll be able to basically understand the financial statements of different companies much better. Okay, I did one more thing here, which you might find interesting. So, the balance sheet items that you have are all connected to the profit and loss items. So the profit and loss items are not in isolation. There are connections between the balance sheet and the profit loss. So this is not exhaustive, but this will at least give you an idea about how some of the easy connections that are there. For example, cash and bank also affects other income. Other assets also affects other income. Accounts receivable affects sales. So we've just seen in the case of Colgate how they have deliberately allowed a very liberal credit policy, giving a lot of credit to their buyers to push up their sales. These figures, in fact, are from the Colgate-Palmolive only. So you can see that accounts receivable and total sales, the connection is very clear. Then you look at cost of goods sold. This actually gets influenced by accounts payable. Are you able to get credit from your suppliers? If that is easy, that will also allow you to produce more because your cash outlay is less. And that will have an impact on the cost of goods sold here. Then the sales, general and administrative expenses. This again has a link with other current liabilities and provisions. The interest that you have here, which you pay, is definitely linked with your long-term liabilities. The dividend that you pay is, I have not made that arrow here, but it will be linked with the share capital, which is reflecting here in net worth. This is a very easy one. Fixed assets will link with depreciation and amortization. Similarly, intangible assets will link with this. So my basic point is that when we look at these two statements, we should not look at them in isolation. We should understand always that these are linked with each other. So that was, I think that brings us to the end of today's class. I'll send over the assignment to you so that you can try to do it. If you are unable to do it, let's say during the week, then we will take some time during the class on Saturday to come to do that. But I want all of you to do that and submit it to me so that it is there as an assignment. I need to have something from you also, which shows that we have done something here. So we'll be having some more of these little assignments, and you can keep submitting them to me. It will help you to brush up your own understanding of these different subjects, and at the same time, it will give me a basis for evaluation. So even that is necessary. So that during the course we did have an assignment. So can we end here today then?
Yes, sir.
Okay, sir.
Did you find this interesting, this class today?
Yes, sir.
Yes, sir.
Yes, sir.
I think that is a big compliment then, because this is a subject, this financial statements, which personally I have always struggled with. It is a fairly monotonous subject, but thanks to some reading which I was doing these days, I was able to come across these two different approaches. This common size and index based, both of which allow you to do some meaningful analysis and which give you a certain perspective into financial statements, which maybe you did not have before. Thank you for patiently listening and participating in today's class. So we will meet again next Saturday. Bye for now.
Okay, sir.